be very good.
I start this one.
That's right. The panelists may be requested to raise their hands when the name is taken.
Yes.
And introduced formally to this August gathering.
Yes.
And Professor Madan, can we make a request to all panelists to convert their addresses into little write-up also, which can be later published?
Yeah. Almost all feel like this. They
That's
are.
right. Thank you. Because in the morning also, in the chat box, there were number of comments that we should be getting.
Our Vice Chancellor, Professor Kishor S has also joined us.
Okay.
Welcome, sir.
Welcome, Professor Tankeshwar Kumar, Vice Chancellor.
Thank you, sir. Thank you. I was enjoying your discussion. Yeah.
Okay. Yes. Thank you.
Yeah.
Thank you, sir. So I think we can start the session.
Yeah.
Professor Bishnoi.
Yes, sure. Sure.
So I, with the permission of our president, I start this session. Okay, sir, we can start now. So I welcome to all the resource persons, delegates, members, executive committee members of the Indian Economic Association on our first technical session that is on economic revitalization, situation and challenges in key sectors under this 103rd annual conference of the Indian Economic Association. So firstly, I welcome the chief guest of this session, Professor Charan Singh, the Chief Executive of the Economic Growth and Welfare Foundation, the IGRO, in Delhi, Noida. And he has worked at so many places where he worked at IIM Bangalore, I remember for him, and just full introduction will be given by our moderator, Professor N.K. Bishnoi, because Professor Bishnoi is the chairperson of the Department of Economics, Guru University of Science and Technology, Hisar. So this university is organizing this our technical session. I welcome Professor Tankeshwar Kumar, Vice Chancellor, Guru University.
Dr. Badri.
Yes.
Professor Badri Narayanan has also joined. Welcome, Dr. Badri Narayanan.
Okay. So I also welcome Dr. Soumya Kanti Ghosh, Group Chief Economic Advisor, State Bank of India. Dr. Ghosh, you can raise your hand so that the participants should know about you. Thank you. I also welcome Mr. Dharmkirti Joshi, Chief Economist, CRISIL Limited, that is a rating agency from Mumbai. I welcome Dr. Badri Narayan Gopal Krishnan, Senior Economist, University of Washington, Seattle, USA. Dr. Badri Narayan. Hello,
Yeah,
Dr. Professor Bishnoi has joined?
Yes, he is there. He is there.
Okay.
On my screen, he is visible.
Okay.
Hmm.
I also welcome Professor Emma Moti, Director, Institute for Studies in Industrial Development, ISID, New Delhi, for this session. And Professor S.K. Mohanty from Research and Information System for Developing Country, New Delhi. I welcome to you. Professor Mohanty, please raise your hand. Thank you. So, in this session, Professor N.K. Bishnoi is the moderator, and this session will continue up to 6 p.m. So, just by not wasting much time, I just invite Professor N.K. Bishnoi to introduce this session. Thank you.
Thank you, Dr. Madan. Good evening to all, and welcome all the delegates to this session on economic revitalization, situation and challenges in key sectors in India. So this is 103rd annual conference of very prestigious economic association, where the economics from academics and other professional fields are participating. And I am very thankful to the President of the Economic Association, Professor V.K. Malhotra, and also Dr. Madan, the Secretary of this association, for giving me the opportunity, or giving my university the opportunity to organize this prestigious event for the Indian Economic Association. So on behalf of my university and also on my personal behalf, we are very thankful to you for giving this opportunity. And this session, as we all understand, as introduced by Professor Madan, is very important in the sense that the world economy and also Indian economy had been going under a turbulent phase, because particularly India, before the onset of this pandemic, Indian economy was facing a number of structural and cyclical issues, and some pressure was there on growth, as evidenced by the fact that in the last financial year, our growth was something around just about 4%. That was much below the potential growth of the country. And thereafter, in the last week of March, this lockdown was imposed, because there was no other option but to have lockdown to restrict the movement of goods and services, to stop the infection of a disease where there is no medical, cure is still available. Hopefully soon we will be having a vaccination or things like this. So because of these things, Indian economy tanked almost, and in first quarter of the current financial year, we were minus 23% growth. And again, next quarter, we were expecting that growth will be by minus 10, 12, 13%, but luckily it was around 7.5% or something like this. So this event is a non-economic event. The more important thing is because it's a non-economic event, so it becomes very important to understand that how things are going to pan out, and how to manage the economy and how to manage the things in future. So a lot of challenges are there. Government of India has been taking a number of steps, like opening the coal sector, nuclear technology research for private sector. They are also having new labor code. They are having number of reforms in banking, non-banking financial institutions, more FDI in defense, and number of other things. So agriculture laws are also one of the issues, introduced by the government. So India is a democracy, a noisy democracy. We understand all the time there have been a lot of debate that this step is good or bad. So some are arguing these are the very good steps that can take economy to a newer heights. Others are skeptics are also there. They feel that these steps are not sufficient enough. So in this debate, we think the Indian Economic Association has one responsibility to come out with its own view after deliberations. So for this purpose, this panel discussion is being organized. And luckily, we have very eminent economists from the country and even abroad who have been monitoring the Indian economy very closely, or have agreed, consented to be part of this discussion, as mentioned by our Secretary of the association, Dr. Madan, Professor Charan Singh, Dr. Soumya Kanti Ghosh from SBI, then we have DK Joshi Sahab from CRISIL, Credit Rating Information India Limited Company. We have Dr. Badri Narayanan, who is from Seattle, Washington University. And we have Professor M.R. Murthy from ISID New Delhi, very prestigious research institute of the country, and also Professor S.K. Mohanty, who had been a professor at RIS and also associated with a lot of trade negotiations on behalf of Government of India. So with this panel, and we also have here with us our Honorable Vice Chancellor, Professor Kishor Kumar. Professor Kishor Kumar Sahab is our Vice Chancellor for since 2015 for last 5 years, and he is an academician. He is basically from physics, but otherwise the way he understands things, he is more of an economist. So I thought to invite him to have his welcome address by Professor Kishor Kumar ji. And Kishor Kumar ji is a physicist. His area of expertise is nanotechnology. He had written more than 150 research papers. Citation is also more than 150. And he is a very, inspiring leader. He has taken the university to a newer heights. So now I invite Professor Kishor Kumar, our Vice Chancellor, Honorable Vice Chancellor, to deliver his welcome address, please. Professor Kishor Kumar ji. Sir. क्या हुआ? He is there, sir.
Yes, he was there.
अच्छा सर ठीक अभी वो he is muted तो वो unmute करना पड़ेगा.
Sir, I'm asking him to unmute, but they are not accepting.
Okay, Professor Bishnoi, tell him.
Now it's okay. Now it's okay.
Okay.
So they have unmuted me. Now I can speak.
Welcome, sir.
Yeah. Thank you very much, Professor N.K. Bishnoi. Honorable Professor V.K. Malhotra ji, President, Indian Economic Association, Professor D.K. Madan, Secretary of Indian Economic Association, Dr. Charan Singh ji, the chief guest of today's panel discussion, and who is also serving as the non-executive chairman of Punjab and Sindh Bank, panelist, Dr. Soumya Kanti Ghosh, the Group Chief Economy Advisor of State Bank of India, D.K. Joshi ji, the Chief Economist, Dr. Badri Narayan Gopal Krishnan, the Senior Economist with the School of Environment and Forest Sciences, University of Washington, Seattle, Professor M.R. Murthy, the Director of the Institute for Studies in Industry Development, New Delhi, and Professor S.K. Mohanty, a Senior Economist with the Research and Information System and for Developing Country, New Delhi, and Professor N.K. Bishnoi, who are handling this session, and other economists from the country from the academia, multilateral institutions, government, corporate, banking and financial sectors, and all other participants of this 103rd Annual Conference of Indian Economy Association. I take this opportunity and thank the President and the office bearers for giving the Guru Jambheshwar University of Science and Technology, Hisar, an opportunity to host the first plenary session of the conference on the topic on economic revitalization, situation and challenges in key sectors. I understand this is a very important topic and this is very important session because India is looking for the various ways how we can revise our economy and what the secure ways and safe ways can be suggested by the various economists. The session is organized by our Department of Economics of the Guru Jambheshwar University of Science and Technology. I congratulate them. I congratulate all the staff member and Professor N. K. Bishnoi. And let me take this opportunity to tell you that this university has just, celebrated its silver jubilee. I just mean to say that this is 25-year-old university only. And within this time, this university has gathered international as well as national rankings. And this university, is A-grade, NAC A-grade university since 2002, right? That is means it's just after 7 years of its inception, it became the A-grade university and it is continuing. And it is at 94. It is at now 94 rank in the 2020 ranking of the NIRF. That means we are among the first 100 universities of the country. And not only that, we have got the International Times Higher Education ranking also. That means we are internationally recognized and we are among the first, among the 801 to 1000 universities of the world. And for physical sciences, we stood among the 600 to 800 ranking universities of the world. So this shows that how this university is progressing and has progressed in the past, I say the last 25 years. And in addition to, I also say that this university has, many foreign collaboration. You can imagine also that we have global initiative academic network, and we have more than 11, faculty members from the foreign visited us. And this university has, H index of 87. 87, that is highest in this region. And because of this H index, we were granted the first grant from the DST of about 10 crores. And we also have RUSA innovative and innovation product, which is of the 50 crores, right? So that shows that the university is progressing very fast, and this university is essentially looking for science and technology, management, and all related issues, the economy and psychology. I say physiotherapy and these things are very important along with any to grow with the science and technology. It's without economy, it cannot grow. And we have this department only in the last 3 years. We are having this department. We have started MS Economics as well as BSc Economics. It's a 5-year program and it is fitted into our national education policy also. So I wish that this once the things normalize after COVID-19, we can plan some event and invite all the luminaries of economics profession at the university and take this privilege to host them. And on behalf of the Indian Economic Association and GJST SR, I welcome all the participants, all the panelists, and I once again thank our President of Indian Economic Association and Secretary for giving us the opportunity to host this session. So with these words, I once again thank all of you and congratulate all the participants and wish you success. Thank you very much. Jai Hind, Jai Bharat.
Thank you.
Thank you, sir.
Thank you, sir. Thank you.
So now I invite our first panelist, Dr. Soumya Kanti Ghosh, to deliver his talk. Before I invite, I would like to give a formal introduction of Dr. Soumya Kanti Ghosh, who is presently Group Chief Economic Advisor, State Bank of India, and previously he had worked for ICRAR, FICCI, American Express, and ICRA. He had more than 25 years of professional career. He had also been a visiting faculty to IIT Kanpur and IIM Rohtak. Dr. Ghosh had been a co-author of a pioneering work to capture payroll data in India for the first time, both formal and informal sector. Following this report, EPFO and ESIC had started giving monthly payroll data. He also served on the Indian Banks Association's Monetary Policy Group. He is widely consulted with by the SEBI, RBI, Government of India, and he's also very popular figure in media circuits. We can see him on TV and also writing prolific writer. He it all the time. You can see his articles, his views published in leading newspapers of the country. So he's a PhD from JNU, and he has written a number of research papers, chapters in edited books, and articles in newspapers. So now I invite Dr. Soumya Kanti Ghosh to please enlighten us with your views. Ghosh, please.
Thank you, Professor Bishnoi. It is always a wonderful opportunity to speak on this occasion, and the pandemic has actually taught us a lot of things, and that will form a part of my speech today. But jokingly, I think just yesterday I saw there was a joke on a lighter note going on Twitter that I don't want to get into 2021 if you show me a trailer. So on a lighter note, I would like to say that 2020 has been challenging. It has been devastating also in terms of the economic, but it has taught us a lot of things. So that in terms of the policy making, that in terms of the other aspects, the human behavior, the human psychology. So what I would like to do is I would like to go ahead and speak a little bit on each one of them, so that can give you an idea about what exactly has been 2020 about and how we move forward, and of course the outlook on the Indian economy, which will come as a prognosis of that. The first thing I would like to mention is that I think there has been several writings in the media. There have been several critical appraisals of how India handled COVID, but actually if you do an econometric exercise of, and we actually did that, of an two-stage least square model. We are not getting into the details of that because of paucity of time. Two-stage least squares model, whereby you try to find out the actual positivity rate based on the number of tests, and then using population as an independent variable, because the idea is that the population should be used as a control variable to understand how India has done. And if you actually do the exercise, the total number of cases which is now in India is more than 1 crore. The model actually shows up the figure which is higher than the total number of cases. The number is higher by around 4 lakhs or so. That's not a big amount, but the important point to note is that if you adjust for population as a control variable, and if you adjust for the number of tests and the infection based on the actual number of infection which the state has, India has done relatively well. Of course, there are some lessons which we need to learn. For example, the issue of migrants. Also, the fact that the important finding is that some of the states which are actually a better health infrastructure, for example, states like Maharashtra, states like Kerala, states like Karnataka, some of the states which have a better health infrastructure, some of these states may not have done that well. But the states, for example, like Odisha, states, for example, like Uttar Pradesh, for example, which is the size of the Brazil, and which has done a significant number of tests, have actually done quite well in terms of containing the cases. So my sense is that India has done well. Yes, the number of, and the fatality rate also, I think, has been around 1.5% or so. In this context, I'd like to mention one important point, and which could be very important for all of us to understand, because now that there is a new different strain which has come into it, which a lot of people are calling it as COVID-20. I think what has been happening in the last 2-3 months, as India has attained the peak on September 16, and now it has progressively come down. And why it can prevent a second wave in India is that if you look into the number of cases which are coming from the top 15 districts and the number of cases which are coming in the rural areas that have been the number of cases which are coming from the rural areas that are progressively coming down from July, from a high of 54%, it is now less than 40%. But the number of cases in the top 15 districts, which earlier actually had shown a decline, has been showing a steady increase. But the important point is that the fatality rate and the number of new cases in these overall 15 districts is showing a decline as a percentage. So this means that perhaps India has developed a sense of herd immunity. This is an experience which Italy has also been experiencing. And if that is the case, that could be good news for us in the next 2 to 3 months as we actually fight out and await the news of a new vaccine. So this is the first point. The second point is that why I talk that this crisis is actually an important one, because I will just borrow an wisdom from Professor Mihir Rakshit when he wrote in the 1997-98 regarding this Asian crisis, when he talked about learning and unlearning from the Asian crisis. So if I just take the liberty of using that phrase by saying learning and unlearning from the COVID, I think there has been a lot of positive, changes which has happened in COVID, some of which actually is benefiting the Indian economy. And this I will mention in a while. For example, the first thing is that there has been a lot of behavioral changes which has happened during the year. The first behavioral change which is benefiting us basically in the deleveraging of the consumers. In last year also, the consumers have actually built up a lot of insurance products, and this year also the consumers has been very much, if you look into these consumer behavior payments, there's been a lot of deleveraging. So that's why you were a little bit confident on the retail loans, which a lot of people are saying that could actually go bust. But our sense is that the deleveraging by the households and also the corporates has been very significant. And that is one way of saying that the banking sector is likely to withstand the crisis much better than what it did in the 2008-9 financial crisis. And for example, one of the example, and the other example is that the consumers have also used this opportunity to build up and products, for example, health insurance products and insurance products, which is always a welcome development in a country like India where insurance sector is largely under-penetrated. Another positive development is that, and which has helped the auto sector to come down from the current, sector of negative growth, is that people have actually started to embrace cars in the low end, medium, entry level segments. And if you look into the data of these car makers like Maruti, like Hyundai, all of these have seen a significant jump in the entry level segments. And that is one of the reasons why the car sales have actually surprised us on the positive. There are also other positive things which has happened. For example, the digitization and the UPI data, which in February, today, the UPI data is actually 2 times larger than what it was in February. And the bank's digitization actually has gone at a significant pace. The footfall in the branches has declined significantly. For example, a bank like State Bank of India, right now the total amount of digital transaction is more than 90%. The footfall in the branches have significantly declined. We have a customer base of around 43 crores. So we can understand the benefits of digitization. And interestingly, in the month of July, when we are at the height of the pandemic, the State Bank of India has disbursed the maximum amount of retail loans, and that was through a digital application. So this is one extremely positive development which has made that forward. So this is one thing. The other important thing is that regarding the human psychology. Why I call it human psychology? There is an interesting paper by Defoe, and there is also an interesting paper which in public domain, which compares, and we also compared it with the plague which happened in London in 1620 and the current pandemic crisis. We found out there was a lot of behavioral changes which happened during that time, and they are same as of today. For example, one of the behavioral changes which happened in that point of time, at that point of time, was the people also apprehensive about disclosing the identity of the disease. There was also lockdown at that point of time. There is also the habit of using more homemade food at that point of time. And that's why you will find that in the initial part of the beginning, most of these people were actually apprehensive from ordering from outside and homemade food. The other important things is that there has been also an increase in some of the altruistic behavior on the part of the consumers. You have seen in the newspaper also that people have been very much eager to help the poor and the needy in this course of time. So that is another, and this also happened in 1650. So the point is that the human psychology doesn't change over years, or even over decades. So this is one thing. The other points is that, I mean, which I would also like to highlight, and which could is very beneficial for some of the industries. Like, for example, as I said, people have been using the low-end car segments. In the countryside, we have found out that the village side that people have been actually using the bicycles much often. So there has been an increase in the bicycle prices. There has also been other behavioral changes like increase in the paper prices, cardboard boxes, because people have been ordering a lot of products from home. But all these behavioral aspects had one thing in common, is that it actually had helped the economy to gain faster traction. Here I would like to mention one point. If I now come using this behavioral traction of how the GDP prognosis looks about, I think, as all of you know, that in the beginning, earlier part of the year, we are all staring at a GDP contraction of less than 10%. In fact, our contraction growth initially was 10.9%, but we have now significantly slashed the growth projections, and that is now currently at 7.4%, which is pretty close to the RBI number. You know, one of the points where the Indian economy recovered such significant ground was again because of behavioral changes. What happened is that in the second quarter, when the economy was opened up, the lockdown was strictly opened up, there was an avalanche of transfer of manufacturing commodities across state borders. And what it helped is that it actually, because of the commodities were transported, it helped the trade, transport, communication and broadcasting subsector in a significant manner, in such a manner that manufacturing, the total GDP loss in the first quarter was around 11 lakh crores, and the total GDP loss in the second quarter came down to only 2 lakh crores. And the manufacturing sector was able to recover 93% of the losses which had happened in the first quarter. Apart from that, the communication sector, the broadcasting sector was able to recover 80% of the losses which had happened in the first quarter. So it was a recovery which was led by the manufacturing sector, pent-up demand, but because of the help was expended by the communication subsector. Let me also tell you another important point is that people staying at home and working from home has also held this component significantly better, because we have found that the number of subscribers in the telecom, which has significantly declined in the first couple of months, have jumped by around 1 crore in the 3 months beginning June. So that is also the communication subsector, and of course there has been a surge in the data usage, because as you know, working from home has also has other advantages. So again, this is a behavioral change which perhaps has made the recovery much faster and anticipated. But here I would like to make a matter of caution. We all talk about a pent-up demand. Yes, the manufacturing sector is witness to a pent-up demand, but the service sector actually, there is no pent-up demand in the service sector, because whatever is lost in the service sector, if you lose a vacation, if you lose a meal in the month of May, you cannot have 2 meals or 2 vacations today to make up for that. So while the recovery is actually happening very fast in the manufacturing sector, but I think this recovery will be 2-paced or even 3-paced, with some of the sectors going faster than others and some of the services sector actually lagging behind because of this particular reasons. Now, let me tell you another behavioral aspect, and which again has an important implication of the economic behavior of the one of the economic data, that is basically the inflation. As all of you know, that inflation has significantly accelerated in the last 7 months. In only last month it decelerated due to 7%. But do you know that there has been also been research in other countries? There has been papers by Cavallo in US, and we did a similar exercise in the Indian context, and we found out that in the beginning of the year, what was happening is that people were sitting at home, they were not consuming services sector. So service sector actually has a 27% weightage in the overall CPI basket, which the RBI tracks. And given the fact that these commodities were not consumed, that was a missing product problem. Whenever you do a normalization exercise, these weights actually get adjusted to the food prices, which is a 46% weightage. So because of this statistical artifact, inflation actually accelerated in the first couple of months. Inflation since then has declined, but our sense is that as long as the service sector activity is not resumed fully, and you are not consuming in service sector activities, the statistical artifact will remain in place, whereby a large part of the weightage of the service sector could be transferred to the food prices, and that could end up showing an inflation number which is maybe higher than the market expectation. The unfortunate part is that in the Indian context, as all of you know, we follow a last year's Pache index, wherever the weights are fixed. The CPI was fixed from the 2011-12 one. After that, there has been no change in the consumer expenditure survey. So until and unless we follow the inflation, we measure inflation through and change in weights like the Pache's index that every developed country does, I think it will be always a problem on the part of the inflation measurement. So this is going to be one problem which will possibly hinder any possibility of a monetary policy easing in 2021 and even beyond that. So that is fine. Finally, I will also talk a little bit about the monetary policy and the fiscal policy. I think the monetary policy under the current dispensation of in the RBI, if I just take a minute and reminisce the words of Ben Bernanke, which when he made in 2003, that of a constant discussion in the monetary policy making. I think this RBI has been an absolutely brilliant example of a constant discussion in monetary policy making. It has actually gone through and used many unconventional policy measures which has held the market in a significant manner, and that is one of the reasons why the Indian economy has regressed at an enormous, much more than anticipated speed what we are anticipated. For example, as all of you know, that monetary policy works with long and variable lags, but because of this unconventional policy, by keeping the liquid system in a liquidity surplus mode for a longer period of time, when the RBI had cut the rates by 115 basis points, it took only 3 months for the banks to cut rates by 90 basis points. There has been also financial stability has returned to the market. The NBFCs are now able to borrow at much lower rates. The spread between an GSEC paper and the NBFC paper has significantly narrowed down. But the problem over there is also an added problem in this case is now markets are actually, people are borrowing in the market, long end of the market at rates which are basically even lower than 6%. So that is one problem which has happened because of the abundant liquidity. But I think but the motto of the RBI has been to giving growth a chance, and from that point of view, giving the fact that it has brought back financial stability to the market, helped monetary transmission, reduced the spreads, and allowed the NBFC sector to recoup much of the financial fragility which we are facing, has been a wonderful step. And regarding the fiscal policy, I think we can always discuss about the fiscal policy being more proactive. And I think the governor, I think the Honorable Finance Minister has indicated that they are going to look into fiscal policy, maybe as a tool for a growth-oriented budget. But if you look into the fiscal policy, overall fiscal policy, some of the measures in the fiscal policy is in terms of an off-balance sheet liabilities. For example, the case of the credit guarantee scheme, which the banks have been given the responsibility, that has worked wonders. It has worked very well in all parts of India. And that is one. And there are also several other policies for the fiscal one, which has worked better. But my sense is that at the end of the day, and also there has been some surprises on the fiscal numbers, which you could see in the next couple of months. So even the fiscal deficit, consolidated fiscal deficit number, which was, we are looking at some point of time at 14 to 15% of GDP, that may be now well below around 11 to 12% of GDP. So overall, I would, overall, I'd say it has been a lot of learning and unlearning from the crisis. And finally, one point, since I have worked on this employment one, I want to take 1 minute to say about the labor market disruption, which perhaps may have been a little bit inimical to what has happened, because as you know, there has been a lot of, there has been a significant amount of cost reduction by the companies, and they have recorded enormous profits in the second quarter. This is a policy which has been happening in the last 10 years. Even all developed economies, if you look into the wage cost as a percentage of GDP, that has been declining significantly. India, the decline perhaps has been a little more, little more than what we have seen in the other countries. And what has happened is that even the small firms that have a turnover of less than 50 crores in the listed space, they have also cut employee costs significantly. So this could be one factor of labor market disruption, of employee costs being cut significantly, employee layoffs has happened, that could actually have a significant impact on the consumption going forward. But we are hopeful that earlier we are talking about a double-digit contraction, but to end our forecast now for the Q3 actually sees that there could be a marginal positive growth, and the Q4 there will be a surely positive growth. Earlier it was all quarters we are witnessing a negative one. So I'd like to end here by saying that it has been 2020 has been unleashed a lot of learnings from us. There has been some of the learnings have actually could have positive implications of the economy, but some of the learnings, obviously, as we have said, in terms of the inflation, labor market behavior, could have consequences for some economic policy decision in the coming future and otherwise. Thank you.
Thank you, Dr. Ghosh. Dr. Ghosh is an eternal optimist, and we must take him very seriously because he's been rated one of the best forecaster by Bloomberg for last 3 years consecutively. So when he says that things are improving fast, so we must be happy. And thank you very much also for keeping the time limits in mind. So now I take the opportunity to invite Dr. DK Joshi from CRISIL. Before I invite, I would like to have an introduction. Dr. DK Joshi leads the economic research agenda, and he is the primary spokesperson for the CRISIL on macroeconomic issues. He has extensive experience in macroeconomic analysis and medium-term assessment of the economy. He was a member of the working group of savings for the 12th five-year plan. He is currently a member of working group on revision of wholesale price index set up by the Government of India. He is also a member of industry monitoring group of the RBI. He is member of economic policy group of CII and Indian Merchant Chamber. He is regularly invited by pre-policy consultations with the Governor, Reserve Bank of India. He has also attended the meeting of Prime Minister with the key economists in 2018 and 2019. He regularly writes popular articles and research papers. He has 32 years of experience, and actually he's done his master's and graduation from Punjab University, Chandigarh. So with these words, I invite Dr. Joshi to make his presentation, please. Dr. Joshi.
Thank you very much, Professor Bishnoi. Good evening, everyone. I would like to thank the Indian Economic Association for providing me this opportunity. It's both a pleasure as well as a privilege. We are at the fag end of 2020, a year that we all would like to forget, but that's unlikely to happen anytime soon because even though the vaccine together with the herd immunity that is developing will eventually silence COVID-19, but the scars that it will leave behind will take a lot of time to heal. Well, I'm not going here to talk about the scars which will become visible, I think, after COVID-19 is over. I'm focusing more on the current aspects related to COVID-19, and these two aspects are, number one, its impact on the economy at the macro level and also at the broad sectoral level. And then I think in context of what's happening, I will also talk about the policy response and what more might need to be done. Now, coming to the macro and sector impact first. Well, I think Dr. Ghosh was also pointing out about the uncertainty and predictability. Well, the path of COVID-19 has been quite unpredictable and it's exponential, non-linear, whatever you might like to call it. Consequently, as a result of that, I think the forecasts for the economy, which are typically shaped by the COVID-19 curve, have also been very unreliable and frequently changing. Until a few days back, we were revising our growth forecast downwards, but now I think the upgrades on growth are taking place. And that's because we have been surprised positively. There's been good news both on the COVID-19 front and also on the economic indicators. Let me very briefly talk about the economy front because Dr. Ghosh had covered part of it. The positive surprise in the economy was that we got minus 7.5%. I think in a normal year, minus 7.5% would have been a disaster, I think, but the expectation was that the economy is going to sink much more than what came in finally. I think so it surprised positively. The second, I think, point was that we are depending more now on non-official sources of data like Google Mobility and other high frequency data which help you gauge the path of the economy. And they were pointing out that manufacturing was turning positive. And what we saw by the end of the second quarter was that in sectors such as tractors, for instance, two-wheelers, cars, even rail freight, power consumption, these had actually gone above the pre-pandemic levels. So basically, I think this strong momentum has continued beyond the festive season, although there are some signs of flattening out in some segments. On the COVID-19 front, I think the COVID cases have remained, we all know, have remained under control for the last 2 to 3 months. Recovery rate is very high at 95%, and it exceeds the infection rate. So that brings the overall COVID curve down. More importantly, I think people are learning to live with the virus now. I think COVID cases rose exponentially in the second quarter. For instance, I think the average caseload was 422 per million in the first quarter. And in the second quarter of this year, it was 4,000, more than 4,000 per million. But people mobility, economic activity did pick up. I think though that's telling you that I think we are also gradually learning to live with the virus till the time it is completely stamped out. Now, taking into account these developments, I think we now expect India's GDP to shrink by only 7.7% and not by -9% that we had forecast in the month of September. Now, this is the overall GDP, and we all know that the aggregate GDP often masks the spatial dimensions, the sectoral dimensions of growth, and that's where the nuances or the dichotomies as far as the impact of pandemic is concerned are visible. I mean, they're not visible at the aggregate number. There are several trends one can talk about, but I have, given the time, I'll talk about 4 such key dichotomies. The first one is relates to the firm size. I mean, the smaller firms have been hit much harder than the larger firms. CRISIL recently did a study on corporate profitability, which shows that smaller the company, that harder it has been hit. So the next round of financial stress could emerge from smaller firms. We also found that the large players were still growing, but the small players which have low bargaining power, they're generally cash crunched. The banks are not willing to give money to them. They all remain in the red. Also, I think in the consumption sectors, in the commodity linked sectors, the large players continue to grow positively and the smaller players continue to show negative growth, I think in the second quarter as well, where the economy we said was there was a positive surprise. I think the export segment has been a little interesting. I think here again, the small versus big dichotomy does play out. The smaller textile business, for instance, the ready-made garments, cotton yarn, they suffered chronic pain. While if you look at services, the IT services, they were quite resilient, actually both for the small firms as well as for the large firms. So clearly we see different patterns of growth emerge at the sector level. The second dichotomy, which I think Dr. Ghosh also mentioned, and I'll also talk a little bit about it, I think is the industry versus services. Well, I think the contact-based services in general suffer more because of restrictions and also because of what I would call residual anxieties. I think even if you get a vaccine, you start vaccinating, I think the people will still be cautious in consumption of many services. So what we saw in the first quarter of this fiscal, where economy contracted by minus 23%, which Professor Bishnoi was also mentioning, manufacturing sector fell by about 39%, whereas the services contracted only 21%. This was because I think you had shut down the manufacturing segment completely. I mean, it was not allowed to operate because of the very stringent lockdown. But by the second quarter, when the activity was permitted, manufacturing moved to the positive territory, while services actually they continue to be very, very sluggish. I mean, particularly, I think the non-government services, the the services where contact is higher. So this trend is likely to continue even into the second half, because the contact-based services will remain largely subdued, I think, even when the vaccination starts, as I pointed out. And incidentally, this pattern has also been observed in Europe, and where I think in the second lockdown following a very strong second wave, the services have been hit much harder than the manufacturing sector, which still continues to chug along. Now, I think the other interesting dichotomy, which is, I think, particularly unique to India, I would say, I think, given the size of the rural economy here, is the rural economy, which accounts for almost half of India's GDP, has done much better than its urban counterpart. And this is reflected in the better performance of sectors which have rural footprints, such as tractors, two-wheelers, fertilizers, agrochemicals. And we believe there are three reasons why I think the rural economy has performed better than the urban. One, I think, is that agriculture production activity, which is about 15% of GDP, has continued largely unhindered due to its nature, due to normal monsoons, and also, I think, due to the lower penetration of COVID-19 in rural areas vis-a-vis the urban areas. The urban population density, we all know, is much higher than the rural areas, so that the virus spreads much faster. To give you some numbers, currently the rural India accounts for about 65% of India's population, but only about less than 55% of COVID cases. The second reason why rural is doing better is that the government support is tilted more towards the rural economy. We've seen 50,000 crore additional resources being pumped into Manrega this year, and also close to 40,000 crores disbursed under the PM Kisan. And no such scheme is available for urban poor. And I think third and very important, I think, is that the structure of the non-agriculture economy also, I think, is more resilient in rural versus urban, because, as I said, the services get impacted more, and services have a lower share in rural India. So while the rural economy contributes about 51% to the manufacturing GDP, its share in services, if I exclude public administration and defense and utilities, is only about 26%. So a harder and lingering hit to services means more impact on urban than on rural. And finally, I think the other dichotomy, which I think many people refer to as a K-shaped recovery, is that the markets versus the real economy. The stock markets are booming, low interest rates, liquidity being injected into the system by our central bank, by the global central banks, I think, has inflated the asset prices, and the stock markets are one of them. So even though economies are in technical recession, the markets are up. And this is largely because of the lifeblood supplied through low interest rates and liquidity, which reaches these markets much faster than it reaches the broader economy. So what are the policy implications of this? Well, I think, as I mentioned, the smaller firms have been hit harder. So the next round of NPAs for the banking sector could originate from the micro, small, and medium enterprises rather than larger corporates. Larger corporates are much better placed from the solvency perspective. They have their cash reserves are quite good. So in the earlier round, I think, when we saw the NPAs increase 2-3 years back, I think that was largely larger firms. So I think in this case, the policy support will have to come from fiscal side, not so much from monetary side, because monetary policy, as I'll explain, doesn't reach these segments. So fiscal support is critical, as the government will have to provide support to these sectors, incentivize job creation, which I think they are doing, but it needs to be scaled up. In the small, I think this is needed for smaller segments, so that the risks that originate from these sectors get reduced, and that is a lesser drag on the financial sector or the banking sector, so to say. Then we have rural versus urban. I would say that there is urban poor as well, urban poverty as well. I think so far we've focused more on the rural. I think some focus on the urban side with a clear sunset clause, I think might be a good idea. Now, as far as industry or manufacturing versus services dichotomy is concerned, we will see that for manufacturing, beyond the pent-up demand, how long this revival sustains. And I think the feeling is that that government will have to give more support to the demand side of the economy, so that these manufacturing products find a market. But I think as far as the services is concerned, I think even if you provide money to the people, they're not going to consume these services, because you will typically try to avoid airlines, hotels, tourism, unless I think it's very, very essential. So I think some policy nuances depending upon the shape of recovery will need to be tuned. And finally, the last point I want to make is on the monetary policy. Well, I think the received wisdom is that in a crisis that we are currently facing, fiscal policy will be more effective than monetary policy. And we also know that monetary policy is now running out of juice. I mean, not only in India, but also across the world. And it has not percolated to many parts of the economy, although interest rates have come down, but they haven't benefited everyone. So, and I think on top of that, one of the biggest surprises and policy challenges this year has been the uptrend in inflation, I think, which is highest since 2016. In 2016, we implemented the inflation targeting framework. And I think we are seeing the highest inflation. It's quite ironical in a year when I think the economy is contracting. So this, what it does is it makes the RBI, the central bank, a little cautious. This restricts their ability to support the economy through rate cuts. Unlike the West, India still has conventional policy headroom, but inflation comes in the way of utilizing that space. So I think, so RBI, since inflation is above RBI's tolerance band, so they can't directly cut rates. That said, I think RBI has done everything it could, and rightly so. It has decided to look through inflation in view of a very deep hit to the economy, and has also guided the markets that and the analysts that they will maintain an accommodative stance all through next year if required. But I think the next set of challenge for the central bank is that the bank credit growth is very weak even right now. And I think because there is very low demand from the credit-worthy borrowers. I mean, the highly rated corporates don't need money; they are sitting on cash. And when you talk about lending to smaller and less credit-worthy borrowers, I think there is huge amount of risk aversion. So these, as I said earlier, these segments will require fiscal support, which is more effective in the last mile intervention. Even for credit provision, I think government did provide support initially, I think in the form of credit guarantees, etc. I think more of that, or in some other form, I think some support to the smaller segments will be required to help the economy. I think I'm an optimist. I do believe that I think next year, if the fiscal support is forthcoming, if the COVID remains under control, we could see a mechanical bounce back to about 10% GDP growth. But I think that will still mean that even in 21-22, the size of the economy in real terms will be not greater than what it was in 2019-20. So we've lost more than a year, I mean, worth of. So clearly, I think so. Let me finish that. I'm running out of time, and many thanks for very patiently listening in. Over to you, Professor Bishnoi.
Thank you. Thank you, Dr. Joshi. Now, I would take the opportunity to invite Dr. Badrinarayanan Gopalakrishnan to make his presentation, please. And Dr. Badrinarayanan Gopalakrishnan is an affiliate faculty member and senior economist with the School of Environmental and Forestry Sciences, University of Washington, Seattle. He has co-founded a global consulting firm, Infinite Sum Modeling. He has also been serving as a consulting economist to McKinsey and Company. Previously, he had spent almost a decade as a research faculty member of the Purdue University and Indian Council of Research on International Economic Relations, New Delhi, after completing his PhD from Indira Gandhi Institute of Development Research, Mumbai. His expertise lies in the analysis for business strategy and public policy, employing a variety of quantitative models, focusing on applied economic research in international trade, energy, environment, and development issues. And as business economist of innovation and new technologies like drones, 3D printing, AI, robotics, blockchain, etc., he advises several startup firms on these sectors. He is widely known for his role in developing GTAP, Global Trade Analysis Project, based model and database used by thousands of researchers across the world. He had published 5 books and more than 100 research papers in reputed journals. He each cited more than 4,200 times by top journals. So he had been a consultant to UN, World Bank, FO, WHO, KPMG, Asian Development Bank, IMF, etc. So now I invite Dr. Badranarayanan to make his presentation, please.
Thank you very much, Professor Bishnoi, for the kind introduction and for inviting me. And respected Professor Tankeshwar Kumar, Dr. Charan Singh, Dr. Somikanti Ghosh, Dr. Sachin Kumar Mohanty, Dr. M.R. Murthy, Mr. Joshi, Dharmakirti Joshi, and all the esteemed delegates of this 103rd annual conference of the prestigious Indian Economic Association. So first of all, my warm greetings to everyone, and hope everyone is enjoying the holiday season and looking forward to a better new year, 2021. And I'm really delighted and excited to be part of this wonderful panel of speakers here. I will focus on a few issues that pertain to India's interaction with the global economy in the context of COVID and post-COVID. What are the changes that are happening? And this is based on some of the research studies I've been conducting with different organizations like Asian Development Bank, World Bank, and several other organizations. Also, I completely agree with what Dr. Ghosh and Mr. Joshi mentioned about the various happenings at a macroeconomic level and at sectoral level because of COVID. And many of the projects that I have done recently, they also allude towards the similar kind of findings, that the recovery has been more positive than expected. In terms of global changes to begin with, geopolitically, there are a lot of major changes that are happening that even started happening before the COVID. COVID issue started, and since the late 2010, since the later part of this decade, 2014-15, we have seen a streak of protectionism, trade protectionism from the countries that have been traditionally championing free trade, like the US and UK and so on. And on the other hand, there also has been a push for a lot of opening up of trade by countries that have been, known as protectionist, communist, and so on. An example being China. So these two things have been happening simultaneously. And now during COVID, just before COVID, what is happening is all these things are getting to some kind of fruition, some kind of climax in a sense, in which the US policies are likely to change in the next few months because of the new administration. And that also partly, the whole regime change is also partly, it could be attributed to the COVID crisis, some of the lack of responses to COVID and so on. So that is one aspect. And second aspect is Brexit that has been finally concluded, UK's exit from the EU. And this has given UK a lot of freedom now in terms of trade policy. And the biggest worry for UK when it comes to trade was the lack of deal with the EU. And the latest news we got a couple of days ago suggests that that is not going to be a major issue, although things like services trade and other issues will remain. But at least the merchandise trade, there is going to be free trade between UK and EU. And UK also has been able to sign many other deals with many other countries. So being with an independent trade policy, being an independent trade negotiator, UK is going to probably succeed in many of the trade deals. Now this, you may wonder why I'm talking about these global changes, which are well known to many of us. The reason is how these things are going to impact India. So for example, if you take UK, UK-India trade agreement has been negotiated in the past few months, and that is likely to accelerate, and probably that can lead to some result. And that is one possibility. Similarly, US-India trade deal also has been under discussions, and that also can move to some extent. So these are certain implications of what is happening globally. And also, as we all know, recently India has come out of RCEP, the Regional Comprehensive Economic Partnership, and that leaves a kind of a vacuum where does India fit in the global value chains, in the global trade. And that is quite important in the context of the current situation because of two reasons. One is it is quite, people may have different opinions, but it is quite, most of them would quite agree that China is becoming less and less acceptable in the global world, in the West, and also in many other countries. So there is an opportunity for countries like India to step up and fill in the space that may be created, the vacuum that may be created. Although it's going to be incremental, it may not happen in a major way because China is dominating the global space so much. There is a possibility that some of the Western and other countries that have their presence in China, they may move their companies to India. And this is happening in a big way, when the opportunities are there in a big way. And how much it can happen depends on how, what kind of policies that we can come up with in India, and what kind of incentives, what kind of investment climate improvements, reforms, and these things can happen to be able to attract these investments. Going by the history, the recent history, if you look at the US-China trade tensions, at that point also we were imagining that India could be a gainer. India could gain by China's loss of exports to US. And that did not happen in a big way because of various reasons, which there's the time we have now to discuss. But broadly speaking, the main issue is the investment climate reforms and so on, where we have been making a lot of progress in the recent years, and maybe we should continue in the direction. And so that is one aspect. And also another aspect is the need for global coordination and collaboration in terms of recovery from COVID, in terms of how can we get out of this crisis, both from a public health point of view and economic point of view. So that goes beyond trade as well. And in this context, I would also like to remind the esteemed audience about the wonderful discussion this morning by Professor Chaturvedi, who mentioned about the Indian trade policy or trade experts. To a large extent, we think of exports as something really desirable and imports as not being so desirable. So we always worry about trade deficit. I think that has to be evolved over time. It has to evolve out of that kind of thinking, and we have to become more and more open, because imports are needed for exports. I think he also mentioned that 35% of exports depend on imports. So that those things are quite important, and that should be the context in which we have to discuss all this, think about all these trade deals. There has to be some give and take, some compromise, but there are certain things that we cannot compromise on. Like in RCEP, China was a major factor and so on. So that's a different issue. But we have to look at it from not only purely from an exports perspective, but also from a holistic perspective. And then also in this context, India has always been in favor of multilateral negotiations. So there is greater transparency when all the members get together and discuss, and there are clear-cut rules and regulations that are defined. So in this context, it is also important for India to push for World Trade Organization, more discussions in the World Trade Organization, bring up the concerns of the developing countries, the poorer people in the developing countries, sustainable development, and all these things in the global forums. I think these are some aspects. So these are some opportunities that are opening up, and challenges that are there, and the policies that need to be further developed, both at a domestic front in order to improve the efficiency and productivity of the domestic enterprises, investment climate, and so on, and compete globally. And that is also consistent with the mission of Atmanirbhar Bharat and Make in India and so on. So the very goal is to attract investments here, make the domestic capacity larger. Then the last two issues I want to discuss. The first issue is beyond trade. So far I talked about trade. Another aspect that has been happening, globally again, is the digital sector, expansion. And here we have not only artificial intelligence or data science or some of these, but the whole gamut of technologies that are available for us, and blockchain or drones, robotics, and so on. So already with both the eminent speakers talked about the recovery in manufacturing, and some of it has been facilitated by some of these new technologies, robotics and so on, where to a large extent contactless manufacturing is also becoming prominent, and so on. So I think in that context, we did some study with ADB on the expansion of digital sector and how it can impact different sectors and so on. So we see major gains there. The multiplier is something like, if you invest $1 in these sectors, particularly not exclusively focusing on these sectors, but in a way that they benefit the other sectors, that can actually lead to something like 2.5 kind of multiplier. So there can be huge multipliers coming from investments in the digital sector. That is one thing that is happening globally, and it also holds for India. Another final aspect I want to mention is about the process of fighting against climate change, and that is a major issue. We all have witnessed, many of us, many of you in India, and particularly in India, we witness some quick relief from air pollution because of COVID, because people are not going out, transportation is not happening, industries are not open. Particularly during the lockdown period, we saw some improvement in air quality and so on. But that is not, as we all know, it's not sustainable, because economy has to come back and we all have to work. In that context, there is an important point here, which is, in the process of recovery, we should not forget the bigger issues in terms of climate change and other environmental aspects. In this context, we have to put in more money there. We have this Paris Accord commitments where we have to reduce emissions and so on. So climate finance, how to finance this, and does it all have to depend on the government, or should it come from other countries, multilateral collaborations, or private sector has to play a major role? All these things have to be put on the plate and discussed. And here I feel like we can go back to Professor Michael Porter, who had this Porter's hypothesis, which suggests that if you reduce emissions, that also can be energy efficient. You can improve your efficiency, and thereby you can save costs. So going towards renewables, reducing emissions, pollution, that can also be positive for the economy. And that is the context in which we talk about green recovery or Green New Deal, and decarbonization of economy while we are recovering from COVID. I think these are the different points, trade, technology, environment. So these three aspects I wanted to discuss. So I think I will take a pause here, and happy to answer questions later. Thank you. Thank you very much again for the opportunity.
Thank you, Dr. Badranarayanan, for giving your perspective on global economy, how it's evolving, and how should India respond to this. Thank you very much. Now, I would like to invite Professor M.R. Murthy, who is the Director of Institute for Studies in Industrial Development, New Delhi. an institute under the auspices of ICSSR. He is director since 2010, and before that he was the joint director of the institute from 26 to 2010. He had been having vast research experience of more than 3 decades in studying various aspects of industrial policy, corporate sector, and foreign direct investment. He had also authored a number of research reports and papers on FDI, large corporate sector, and development financial institutions. So, Dr. Murthy, please.
Thank you, Professor Bishnoi. Chairperson of the session, Professor Charan Singh, Dr. Bishnoi, and other distinguished panelists. And in fact, the topic which I would like to basically touch on to my 10 minutes presentation, a 7-minute presentation is, well, I think the Professor Sachin Chaturvedi in his inaugural address has set the motion on trade, investment, and industrial policies. He briefly said, Badri also had did mention about it. And well, I think I would like to speak on what we have done during the last 65 years of our industrial policy, where we have missed it. In fact, in India, industrial policy is seen as a standalone policy which governs the industrialization. And we have other policies like trade and investment policies separately. And there is a need for looking them together to put them in view of our vast experience of 35 years of our regulated economy, and also 30 years of our vast experience that we have gained out of the liberalization period. Well, I think if you go back to industrial policy, the foundation for industrial policy, we started with regulating the large industrial corporations and multinationals from the policy of 1956. And we have introduced some additional elements in 1970. And also in 1980, we have liberalized a bit by regularizing excess capacities and granting licenses, giving special status to export promotions. All that experience shows that the regulations have suffered a fair degree of implementation issues. Then we went with the 1991 industrial SIT, and that deregulating everything that was mostly the areas which are reserved for the public sector, and also many of the trade and investment policies, import liberalization, export promotion, and kind of things. But in essence, the economic policy program sought to shift the balance in favor of private sector, both in manufacturing and services. However, the investment growth by the private corporate sector that provided traction to India's growth story in the past decade seems to have been losing his steam. Why? At this juncture, what we thought that we should look at it, we prepared a major research program by team of our colleagues at the institute. How would you look at these 3-4 segments? And we have, if you look at the trade policy, we have a trade policy separately, and we have bilateral investment policies, you have free trade agreements, all are never seen together in this one. And then similarly, we have investment policies, technology policy, FDI policy, like that. And we thought we should invest. And the basic reason for this one was in 2017, DIPP has come out with an industrial policy looking into the experience of the past few decades rather, and also made a modest attempt in 2019 to bring up, to come out with an industrial policy for the new and emerging India in the light of the vast experience of regulations and also the liberalization period. But I think from this perspective, we thought we should look into these things and then suggest pathways for industrialization, given the constraints and emerging opportunities. I mean, from this, I think what it comes to, the India should follow the two-pronged policy approach. One is the catching up and keep pace in high technology industries, promote industries which offer employment to vast number of semi-skilled and unskilled workers. And it is important to note that each of the major high-tech industries such as electronics, pharmaceuticals, automobiles, and biotech face one problem or other. In electronics, it is our country is dependent on imports, product assembly with a very high import content. In pharmaceuticals, India is known for its generic products rather than basic research. But even in the generic products, the production of generics, it depends heavily on the imported APIs. The importance of the pharmaceutical sector emerged even clearly in the context of COVID, but for the capacity that we built up on the COVID vaccines by the domestic companies, and underlined the need for strong domestic base of this sector. And we also have an automobile sector. The automobile sector has expanded significantly in the post-liberalization period, but it will be increasingly aligned with electronics, with surge in the use of electronic vehicles, being overwhelmingly dependent on MNCs. The industry is at the risk of perpetually dependent on foreign technology inputs, or even more importantly, changing strategy. For instance, the largest passenger car manufacturer reduced its exports following an establishment of a unit in Hungary by a Japanese parent company. In the present, I mean, the India at present is stuck in the middle of, stuck at the level of middle level technology, which, while much of the employment is provided by the low technology industries. This is evident from the organized sector data as well as from the composition of the large private corporate sector data. India's exports to are moving towards high-end medium technology industries with high import content, leaving India with a little surpluses, if any. Thus, we are unable to benefit from the advantage of cheap labor on the one hand, and not able to generate enough surpluses due to high import content of the technology intensive sectors. Indicators are that participation in the global production network and preferential trade agreement accentuated this problem. And overall, unlike China, India failed to fully harness the liberal trade investment and technology regime. On the contrary, it has acquired some very disgusting features. In FDI dependent path of industrialization, the basic technologies will remain owned by the foreign companies and the multinationals. Experience of the past decade, 3 decades, shows that India cannot develop internationally competitive manufacturing sector on the strength of FDI alone. Withdrawal from RCEP is a clear indication in this direction. The sudden exposure to internal and external competition, the domestic industry failed to gather the strength, while MNCs acquired control over both the high technology industries and consumer goods. The domestic enterprises are more in the middle level technology industries. Technology is the key for many industries to be globally competitive. In the liberal foreign investment regime, MNCs did not find it necessary to share the technologies with domestic companies. On the top of that, they acquired successfully and promoting domestic companies, not only in the pharmaceutical sector, but but also in the capital and consumer goods as well. Technology spillovers from the studies show that remained elusive, especially vertical ones, both due to strong IPR and weak local linkages. On the other hand, India's outward foreign direct investment route has its own limitations in acquiring advanced technologies, especially in the current context of technology protection practiced by developed nations. Indian companies experience in turnaround distress to overseas companies does not also infuse confidence, as most recent case of Mahindra, Sangyong and the Tata's experience in chorus show. In the case of large acquisitions, even Indian parent company cannot can run into serious troubles. In the recent statement, our Honorable Prime Minister had called for a high private sector investment in R&D. India should find ways to invest massively in R&D, especially in high technology industries. Contrary to the expectations of 1991 industrial seat, the competitive pressures failed to force Indian companies to invest in R&D meaningfully. Instead of Instead, most of them choose medium and low technology industries and found an escape to infrastructure sector. Even in that, they are facing serious problems and selling off to foreign institutional investors. Mere increase in R&D would not be enough. For the country to fully benefit from the fruits of R&D, there must be the right type of funding and institutional support from the from the state or the government. Effective control of technology based enterprises should remain with the Indians. This is where finance plays a paramount role. In fact, foreign private equity investors paved the way for foreign institutions, foreign acquisitions of important companies, especially in the pharmaceutical sector. How the private PEs have been playing in this. Given its present position of not being able to access technology and not spending enough on R&D, technology-based domestic companies, which are nurtured through liberal tax incentives, are of immense strategic importance. India should try to minimize loss of domestic potential companies by restricting cross-border acquisitions. On the scrutiny of acquisitions by Competition Commission of India has proven inadequate because of high thresholds, exemptions, and more importantly, non-discriminatory approach, which was contrary to India's stand in international fora. We must try to nurture capable domestic enterprises which act as a nuclei in different sectors and reservoir of technology. Here comes the role of startups. India startups ecosystem, as stated by our Honorable Prime Minister in his recent statement, he showed a beating growth. In the absence of a leading companies, promising startups cannot be prevented from selling off to MNCs. This is a major risk the startups scheme is exposed to. The approach has to be comprehensive and integrated. Domestic enterprises should be given confidence, resources, and some protective shield to take the risk. Restricting mergers and acquisitions alone will not serve the purpose. Positive steps will have to be devised, keeping the sectoral needs in focus to encourage the domestic industry. The focus should therefore shift to better understand the constraint faced by the domestic industry. The focus should be at the sectoral level, with MSCs given their due place not only as a providers of employment but also as fountains of new entrepreneurship. 3 decades of long enough 3 decades is long enough to assess the efficacy of a policy, paradigm, Indian industry is again facing a stagnant situation. And the stagnant situation, I think the negative growth, which I think my predecessors have spoken about it do not, entirely attributed to the COVID. COVID had impacted so much, but I think Indian growth rates have been either stagnating or decelerating during the last couple of years. On the top of that, global situation has turned difficult because of the pandemic. It is therefore the time India goes back to draw the board to devise an industrial policy that balance the dual need of advanced technologies, employment generation on the one hand, keeping the levers of the economy in the domestic hands while steering clear of the exploitations by the others. I think with this I will end. And this is based on the basically on the structural point of view of how our industrial policies have suffered over different phases and the need for relooking it into our industrial policy, integrating trade, investment, and other issues into industrial policy, and then addressing the domestic sector. Thank you, Professor Bishnoi, for giving me an opportunity. Okay.
Thank you, sir. Thank you, Professor Murthy. So your point is well taken that we should have an integrated policy, including trade and investment, technology and other things, so that we can have the right results. Thank you very much, sir. Now we have with us Professor S.K. Mohanty from Professor Saroj Kumar Mohanty is serving at the Research and Information System for Developing Countries, a think tank supported by the Ministry of External Affairs. As an economist, he had been working on trade and development issues, including bilateralism, regionalism, and multilateralism. He had engaged in the bilateral negotiations of India with a number of countries, regional groupings, including Mauritius, Canada, COMSA, Singapore, etc. Recently, he had prepared a study on India's response to rising trade deficit with China. He had just concluded 2 monographs on India's economic linkage with South Asia and India's economic engagement with LAC. So he had been engaged in a number of other negotiations on behalf of the government of India and in part of the team that is, discussing the trade negotiations. His other research interests include trade and employment, South-South cooperation, development cooperation, WTO issues, and technology-intensive trade. Previously, he was teaching at Jawaharlal Nehru University, New Delhi. He had also published a number of research papers in national and international journals, and he also has a couple of books to his credit. So now, Professor Mohanty, please, to make his presentation. Sir.
Thank you, Professor Bishnoi. Thanks, Professor Malhotra, Professor Madan, Professor Sachin Chaturvedi, Professor Charan Singh, my fellow panelists, distinguished guests, ladies and gentlemen. The Indian economy has shown a sign of recovery after getting figures for the improved growth prospects of the country in the second quarter of 2020. IMF forecasted that India would make a V-shaped recovery. Unlike that of U-shaped, it will just emerge from 2020 to 2021 with very high growth over 9 to 10%. I think the same fact is also mentioned by Dr. Joshi and also Dr. Badrinaran. Now, this has brought back the debate on India achieving $5 trillion GDP target in 2024. Prime Minister is also very optimistic that this is achievable. Of course, this is a very Herculean task for any country to achieve that. I think in the past it is not done, but still the country is extremely hopeful of this. During 2019 and 21, it is almost a lull period. Therefore, we can really target for a $7 trillion economy by 2030, which is very much plausible. And also that is very much consistent to our growth trajectory to reach the third largest economy in the world by 2035. It is expected that the GDP of India is to reach the GDP level of Germany by 2025 and Japan by 2035. So if that is the case, then by 2035, we see that, of course, in China and the US would be much bigger economies than India, but definitely Japan, India, and Germany would be a single league. I think that would be completely different from the whole set of economies, large economies in different parts of the world. So that is the trajectory that we have to aim at. But the question is that what is the growth driver? Professor Sachin Chaturvedi in the morning said it is the trade sector. And the same thing also repeated by Dr. Badrinaran also. Now, one should be very clear that we have to depend upon investment upon import for promoting export. We cannot delink both the elements, that we can have a major exporter without importing anything. It is not possible. But what we have seen after decades of high growth of the export sector, it showed slow down in the second phase of the global recession. And that requires some kind of impetus to resume growth in the coming years, so that it could be the growth driver for the Indian economy to reach the target. Now, the focus is about the global value chain, intermediate, which is growing at a very rapid rate. And the rise of intermediate is not only meant for exports, but it is also for domestic production, for domestic consumption. As the Indian economy is growing large and having a very large middle income group, the group has got huge access to the global market because they have got the purchasing power. And unless we produce competitive products domestically with quality, naturally, we really cannot stop imports. So therefore, import of intermediate is very much required for reducing imports of final goods. So, and that is the trend we can see in specific products. In specific products at 6-digit HS, you can see huge imports, more than 50 million to nearly $8 billion. That is the case bilaterally, not globally. So this is the pressure that Indian economy is having. Now, another interesting development in the external sector is that high technology goods export growing very fast. And if we see the last 2 decades, the growth trajectory is quite linear and upward rising. So this is a very positive development that we can see. Another factor, I think, completely unnoticed is about blue trade. The trade which is using resources from ocean. I think this would be the driver of growth in future. Blue trade is growing much faster than the ordinary trade, not only in India, globally. And interesting part is that in blue trade, unlike the ordinary trade where we have got a huge trade deficit and growing over a period of time, for the last 8 years, what we have estimated in RS, that in the goods sector and also services, in both the sectors, we have got a favorable trade balance. So this could be a new sector which would emerge. But what about free trade agreements? There is a fierce discussion in the domestic economy that FTA is good. Some people are saying FTA is bad. And now where to go? So we have seen after in this new millennium, since 2000, we have seen several FTAs, SEPA, SECA got implemented. Nearly 10 of them got implemented during the period of buoyancy between 2003 to 7, and also during the period of first phase of recession between 2008 to 2012. Now, what results we are getting? We are not getting into the debate, but purely going by the statistics. What do you get? Now, we have these FTAs, SEPA, SECA comprehensive economic partnership agreements in different points of time. But to understand the efficacy of these FTAs, we try to see that what has happened, what is the performance level before FTA and after FTA in all the cases. And what we found is that, one, there is a surge in trade, and there is decline in the deficit to export ratio or trade deficit or trade balance to the total trade ratio. So it clearly indicates that things are not bad, and in certain cases, like Korea, like Japan, we have got mixed responses. That means it has improved for some time and also then deteriorated. That means we couldn't sustain what we have dealt with these economies or group of economies. That is another one. So in terms of FTA, what exactly we expect? It is okay in terms of volume, we look at the export import, but what is the qualitative change that we expect? In imports, we definitely be interested in import of primary goods, intermediates, and as emerging economy, we may be needing capital goods. Similarly, but in exports, what will be interested? Exporting of intermediates and export of final consumption goods. And that has been the trend. So the figures showing that were very much consistent with that. But what has happened to the trade balance? We have very meticulously examined that what has happened to those economies with whom we have got FTA, SEPA, SECA, vis-a-vis with those with whom we don't have anything, no agreement. And we have seen that the trade deficit ratio is much lower in those countries, all countries with whom we have got SEPA, SECA, vis-a-vis those who are not having any agreement as such. So that means FTAs are to some extent compensating for the high trade deficit generated by non-FTA countries. That is the conclusion that we have got. But which one is the elephant in the room? It is China. Between 2003 to 2005, we had trade surplus with China. Very interesting. We have a trade surplus. And slowly, it expanded like anything. By 2019, it was $60 billion deficit. Now, people argue that China is very competitive. Supply side is very strong, scale economies. And we are just minor player, just importing 5%, 3% of China's total export to the rest of the world. So we don't stand anywhere. We cannot really negotiate with China, whether it is in RCEP or bilaterally. But it is not correct. In the total trade surplus that China generates every year, India contributes 16% of its global trade surplus. And India is the fourth largest economy to contribute to their global surplus. India is the seventh largest export destination of China. And after all, China is not competitive. In a typical binarian sense, if you look at price competitiveness at the product level at 6-digit HS, it is not very competitive. We try to see in 2018 database where India imported 4,044 items at 6-digit HS. And we found that in case of 3,326 items, China is not the most competitive economy. India tried with other countries which are rather more competitive than China. So there are many myths around China and descriptions are different related to India and China, and this narrative, what Professor Chaturvedi said in the morning, should be changed. Now, what options we have? Should we now truncate our trade linkages with China, no trade with China, or we should go in a limited manner? So no trade is not possible. We have to go in a limited manner. But what? We found that in 2018 data, where we imported nearly $90.4 billion from China, where we imported 4,044 items from China, only in case of 300 plus items, which are the major items, key sensitive items, constituting $66.7 billion. That means only 8% of products can really have the trade or import of 66 or 78% of our imports from China. That means if you block those 300 products, then we can have a very normal trade with them. But is it possible? So we explored that. What are those possibilities? One possibility is that we move out to other suppliers, global suppliers. We can try it out with those suppliers whom we are already engaged with, and also try with those with whom we have not. So we have tried both the players with whom we are still engaged, and with those who have not into the domain of India. And condition is that whether they can really export to that, can really follow that price which is offered by China. So by doing so, we found that there are a huge number of cases where we can diversify. In the past year itself, we can diversify 16% of the total $66.7 billion worth of trade to other economies. They can offer the same price which China offered, or maybe less. So this is cut the long story short, that there are options where partially we can move out, but not fully. There are certain products where we don't find suppliers. It is not very broad sectors like in steel, no, there is no supply. It is not like that. Within a small sector, some products you can diversify and some products you cannot. So it is sector by sector, whether it is API, whether it is steel, whether it is solar energy, whatever you subsectors you take, some products can be diversified and subsectors cannot be done. So what we need indigenization of such products. And that's how we can really compete, and we can make our export sector or trade sector, external sector more competitive. Thank you.
Thank you, Dr. Mohanty, for enlightening us with your insight of India's trade competitiveness with its major partners. Thank you very much, sir, for also keeping and taking care of time limits. So now it is the time to invite our chief guest, Professor Charan Singh, of this panel discussion, a very prominent economist. And Dr. Charan Singh is currently CEO of eGrow Foundation and also serving as non-executive chairman of the Punjab and Sindh Bank. He was a full-time visiting faculty and former RBI chair professor from 2012 to 2016 at the Indian Institute of Management, Bangalore, where he taught comparative monetary policy and policy issues in Indian economy. Earlier, he was a senior economist at the Independent Evaluation Office of the IMF, Washington, D.C. from August 2009 to November 2012. He was also the research director at the Department of Economic Policy and Debt Management with RBI from 1997 to 2009. Singh earned his doctorate in economics from the University of New South Wales, Sydney, Australia. He was a visiting scholar for more than a year each at Department of Economics, Harvard University, and Stanford Center for International Development, Stanford University. He is also serving as the director on the board of National Housing Bank, Delhi, and NABARD Financial Service Limited, Bangalore. He is also a member of the governing board of Policy Foundation, New Delhi, and he is also an honorary fellow of his Koch Development Foundation. So he has very vast domain expertise that include monetary policy, banking, international trade, economic relations, and much, much more. So with these words, I would like to invite respected our chief guest, Professor Charan Singh, to make his remarks, please.
First of all, let me thank Professor Kumar, Professor Bishnoi, Professor Malhotra, Professor Ramachandra to invite me to deliver the chief guest address in this August session. Really thankful to all of you to consider me and giving me this opportunity to talk about the economic revitalization situation and challenges in key sectors. I'm very fortunate that in this session, just before me, I've had the privilege to listen to such highly rated and well-researched pieces by my predecessor panelists. They've all spoken on various aspects of the economy, well-researched, highly documented, and therefore I will, in my address, skip those. Also keeping in mind the time frame that we had, I thought I will not go over the issues that they have already flagged, so I'll skip those and only cover some more issues. And then I have some thoughts which I thought I would like to share with all of you. Yes, you are right. There has been a debate in the country. It's going to be a V-shaped recovery or a U-shaped recovery. It has been discussed by my panelists. But then something new has happened. While the rest of the world is grappling with a second wave, a new variant of the virus has come up. And therefore, we do not know what is going to happen. And unfortunately, the new variant is not only coming from one single country, it seems the variant is mutated and is now coming out with different versions from different parts of the world. Now that makes the vaccine more challenging. And therefore, if there is going to be a new round of lockdowns and new round of the situation that we have just passed in 2020, then 2021 could be a very big challenge. We have to, as economists, as policymakers, keep that in mind now. The second issue that I would like to flag, yes, inflation is raising its head. And the dichotomy between the wholesale price index and the consumer price index is emerging very, very clearly. The WPI is around 1.55 for general and nearly 4.3 for food. The CPI, on the other hand, is 6.9 for general and 9.53 for food. the widening gap between the WPI and the CPI is also a cause of concern. And just not too far earlier, as was mentioned by one of the panelists, we only adopted inflation targeting in 2016. We were following WPI. And now that's becoming a cause of concern. In the month of October, IIP is certainly showing a good, healthy trend. My own feeling, having worked in the Reserve Bank for such a long time and gone through the time when the policy used to be made for a busy period and a lean period, and the busy period is basically the festival period. We are in the midst of the festival period. This is the time when many marriages take place in India. We have festivals one after the other. Christmas and New Year is just, we are in the midst of it. Then will come Holi and then will come Lodi. And these festivals bring in enthusiasm. And my feeling is, as the second quarter results surprised many cynics of Indian economy, the third and the fourth quarter results are also going to surprise them. The reason is simple. The Indians, by their very nature, are hardworking. There's been pent-up demand. There's pent-up consumption. And as the unlocking of the economy happens, I am sure the recovery is going to rebound and we'll recover faster. I am again aware that there are uncertainties because of the new variant and the second wave coming. But given the vaccination on the screen, and also that the herd mentality and the climate changes in our part of the world, and given our dietary habits, I think we are going to record positive growth by the time 2021 third quarter is there. The predictions made by the IMF and ADB and other institutions have all been revised upwards after our performance of the second quarter of 2020. I think those upward revisions will improve further in days to come. To that extent, I would like to thank the policymakers, both in the government at the union level, as well as at the state level, that they have been able to contain the COVID to this extent. Now, I would like to go a little further and say if we want to revitalize the economy, and not only in 21-22, but we have in mind the $5 trillion economy, a target set by our Prime Minister, and as discussed by my panelists, that by 2025, by 2030 and 2035, we should be able to overcome the economies of Germany and Japan. So we need to gallop forward. And in that context, I want to spend the next few minutes. As economists, we all know two things are necessary to grow: labor and capital. India is endowed with a very young demographic labor. Skilling of it has already been done and is being done by the government, both at the union and at the state level. The health challenge which has come, again, we see that there is the seriousness with which the health challenge is being discussed and the plan, the roadmap of how the vaccine comes and the country will be vaccinated. I'm going to today focus on the capital part, because the labor part, in my mind, to a great extent, have been taken care and is being taken care by the union and the state governments. In this, I want to tap my own experience, which has been articulated by Professor Bishnoi, mentioning that I have had the privilege to get associated with the very best policymaking institutions, both in the country in RBI and across the world at the International Monetary Fund, and with the academic institutions, the Department of Economics at Harvard University and Economics Department and the Stanford Center for International Development at Stanford University. The privilege of studying at Harvard for about a year was that I could easily go into the Kennedy School of Government, totally policy-oriented, and the MIT, totally academic, and to some extent, the Harvard Business School, looking at the business world in a different way. I want to tap that experience, and with that experience, I want to make a few observations. I want to discuss three things amongst ourselves, we, the family of economists. We are the Indian Economic Association, And now I'm talking to the family of economists. No finger pointing. I am part of the system, and therefore I thought I'll be very frank and candid in this discussion. If we have to revitalize the economy, and if we have to compete the target set by the Prime Minister, immediate target, and those discussed by we economists in terms of 2025, 2035, we cannot ignore the private sector. We will have to think and go beyond the sociology, the socialist economy ideology or mixed ideology that we had and pursued for so many years. We have to compete, then we have to compete in the right spirit. And the capitalist world, while we were still toying with this idea of the mixed ideology, has marched forward to achieve those dizzy heights, and first to compete with a $20 US economy today and a $13 trillion Chinese economy. No stone has to be left unturned. No stone, even that which is in the private sector. The legacy, considering everything that is private is bad and evil, I think should be of the past. And we economists have a role to play in it. The forward movement of the economy is only possible if private sector can play an important role in development of infrastructure, which they have started, and investing in key sectors. It is now the turn of the agriculture sector. And we economists have to analyze it in terms of the required capital and the available capital and the labor in that sector. In my view, we economists have a very important role to play in this case. Economists could have worked, and I'm one of them, could have worked on the MSP and main beneficiaries of MSP, need for a balanced model in agrarian dominated states, futuristic course of development, etc. for various states in the country. Some of us did, some of us did not. We could have done better. Some of us shied away. If I were in another country, in America, for example, 10, 15 economists would have got together and come out with their view. We didn't in our country. We shied away. But before the independence, there was a Bombay Club, which would come out their own thoughts. And there was another clubs which would come out with their own thoughts. I think we need to evolve as a tribe and start saying things which we are convinced of, or the literature or our training has taught us. The second point which I want to make and flows from this is the area of non-banking financial sector, non-banking financial companies. I am focusing on capital. Just visualize a situation. The Reserve Bank of India, global central bank with vast experience, and I can tell you because I worked there. The commercial banks, again with vast experience, with multinational branches, and I worked in Punjab National Bank before I joined the Reserve Bank. And now I have the privilege and honor to serve as a chairman of Punjab and Sindh Bank. These banks, commercial public sector banks, are globally very competitive. So we have the umbrella, the Reserve Bank. We have well-developed commercial banks. We also have cooperative banks. But do you see there is a missing middle? That missing middle is the non-banking finance companies. And if we are dreaming of a $5 trillion economy, this missing middle has to be addressed. In India, NBFCs account only for 13% of the financial sector assets. In America, they account for 50% of the financial sector assets. They are as large as regulated commercial banks. If we are dreaming of a large $5 trillion economy, we will not be able to ignore the NBFCs. Now, to be brief on this point, the NBFCs are expected to cater to financial inclusion, and retail banking. An initial analysis shows that when the NBFCs went into corporate lending, where they did not have the viability, where they did not have the expertise to assess commercial viability, those are the NBFCs which have suffered the most. When the commercial banks are entering into the retail banking, NBFCs are going to have a tough time. And if we want a $5 trillion economy or a $30 trillion economy, we cannot ignore this segment because they are largely private. No, we can't do it. The problems which the NBFCs are facing are credibility. They have lack of trained staff because there are 10,000 of them, 10,000 of NBFCs operating in the country. They are a black box. If they were not, the rating agencies would not have fumbled on the NBFCs the way they fumbled in India, and of course abroad too. And they don't have even a self-regulatory body. Given these four problems, let me move on. What is the future of NBFCs when we are talking of revitalizing the economy? The 10,000 NBFCs that we see today will have to undergo major changes. Why? Because technology is playing a very prominent role across the world, even in India. And these NBFCs, are they ready for technological revolution? Are they ready for fintech? And when we talk of fintech, we are talking of the mobile banking, which the commercial banks have gone in a big way. And we are talking of peer-to-peer lending. The role of technology and the fintech in NBFCs has to play a role. And I don't think we are ready with it. Now let me come to the recommendation that I have on this. The research on NBFCs is lacking dramatically. The role of NBFCs, the suitable size, the sectors, all lacking. Therefore, I'm suggesting from this forum that we need a separate and a dedicated institution like the NIBM or College for Agriculture Banking, both set up 50 years ago. In the banking sector and the cooperative banking sector, we need some such dedicated institution for NBFCs. And this dedicated institution shall be entrusted the role of undertaking quality research on role of NBFCs, looking at the global experience and ensuring how the Indian economy turns up into a $5 or a $25 trillion economy. There is need for capacity building. There is need for standardizing the documents. And as the country goes forward, the greater role of NBFCs is bound to take place. And if we are not able to train, regulate, supervise, and bring up their standards, the chances of frauds are going to increase. Cybercrime will increase. Money laundering will increase. Therefore, I think we need to take up this challenge as economists and start undertaking research on NBFCs. And of course, we request the institution and the government and top-notch policymakers are sitting in the audience, especially Professor Malhotra. We need to start financing research on NBFCs. The last issue that I want to touch is the fiscal issues. And therein, I find tremendous shortage, lack, inadequate research in our country. The issue is the fiscal policy. And if we have to go in a $5 trillion economy, and one of the economists just mentioned it, in days to come, it will be the fiscal policy which will play a more prominent role. Are we ready with research? 10,000 economists probably in our own country. Have we done enough research? The example of GST is important, and the need to constantly adjust the rates could be the trend. There is need, therefore, I recommend for a permanent fiscal policy committee like the Monetary Policy Committee, available for comments, suggestions, recommendations, and analysis as and when required by the center or the state government. We could have a permanent finance commission, but there is need to undertake research on the aspects, on various aspects of the fiscal policy, both on expenditure as well as on revenue, which is lacking. The other area is the financing of the deficit in these difficult times. can somebody, open challenge, can somebody in India or abroad show me the sanctity of the figure of deficit of 3% of GDP or 60% of debt to GDP ratio? My MPhil thesis is on debt. My PhD thesis is on debt. My postdoctorate study with Robert Barrow is on debt. I have asked everybody at the highest level of the academia, as well as the policymaker, show me the sanctity of 3% and 60% of deficit and debt to GDP ratio. Don't get me wrong. I'm not speaking of fiscal profligacy. I also understand fiscal responsibility. And when the Reserve Bank was, and the government was making the fiscal responsibility bill, this fiscal responsibility and budget management bill, I was in the Reserve Bank on that side of the table and providing inputs. So don't get me wrong. But what I'm saying, in a country like India, given its young demographic, should the indicators which are really applicable to Japan, where aging takes place, be made imposed on India? That's the question I am making. I think there is immense scope of research to demonstrate the relationship between fiscal deficit and inflation. Show me the relationship. This is just a fear out of nothing. The only relevant indicator of sustainability of debt is in the paper by Domer. The Domer formula in the American Economic Review paper of 1944, which is plain, clear, and simple, saying what matters is the growth of the economy vis-a-vis the rate of interest on which borrowing has been undertaken. All other complexities have been added without any sanctity. Should we in our country not undertake research and say this is the threshold level for our country? Nothing has been done. Closely related to this issue is the issue of monetized deficit, which government will have to eventually resort to given the fiscal stress right now and given the uncertainties that I flagged right in the beginning. Is there any relationship between monetized deficit and inflation? None. Given the empirical example of expanded balance sheet of Bank of England, Fed Reserve, Reserve Bank of Australia since 2008, the transmission mechanism in those countries is maximum 8 quarters, and their inflation never took off. And we in India are sticking to that formula. So hence, I think there is need to revisit the Cambridge equation, which may be suitable for advanced countries in normal times, but certainly was not and is not suitable for emerging countries where supply side comes and makes major difference both in normal and abnormal times. The panelists before me spoke about the rising inflation. Is it coming from money supply or is it coming from supply side? And that needs to be investigated, documented, and analyzed. If there is fragmented financial markets in India, does the Cambridge equation work here? Does the transmission policy work here? Where is the research? We have not done enough research. If there is no relationship, then should we not document that? And if there is a threshold, we revise the numbers for India. Finally, in this context, there is also need for extensive research on inflation targeting and its relevance for demographic-rich India. None else but Olivier Blanchard, professor from MIT, whom I first met him in 1993, and later when he became the chief economist at the IMF, and I had the chance to meet him again. He himself said that the inflation targeting levels adopted by the world are probably in for revision. And we in India are shy of it. In this context, should a young demographic India have a target of 4 ± 2? This is very relevant in the present context, where unemployment and growth must be the dominant factor. And we as leading economists in the country have to flag it out. Is it the employment that matters today, or is it the inflation figure of 4% or 6% or 8%? I invite my panelists and other economists to look at the trend of inflation trend in our country, the tolerance limit of inflation in our country, and see, should we start getting worried when inflation is 6% and unemployment is high? I think there is need to rewrite the textbooks of macroeconomics. especially for emerging countries, and especially for India, because our demographic trend is just not there in any other country. And from where better than India can this start now? Let me conclude. I think that we economists in India have for too long lazily, let me repeat, I think we economists in India have for far too long lazily depended on Western hypotheses and theories without testing whether they are relevant for our country. I think time has come when we need to pull up our socks, put on our thinking turbans, and start thinking of discovering our own theories. Some Western concepts may be relevant, many will not. And we shall have the confidence to tell the world of our discovery of theories and hypotheses. Believe me, many countries like us and way behind us will benefit from our research. Truly, then, we economists from India will be able to claim and contribute to Atam Nirbhar Bharat, the call for the day. Thank you.
Thank you, sir. Thank you very much for your thought-provoking and insightful discourse on this relevant theme of the country, organized by All India Economic Association in this panel discussion. So we have come to an end after a very fruitful, very intense discussion with a lot of insight by very prominent experts and speakers in this session. Slightly, it went beyond the time, but I think it is worth it because the type of things discussed over here are highly relevant to all of us, and we have learned a lot. We have got new insight in a lot of things. So on behalf of Indian Economic Association, on behalf of Guru Jammu Kashmir University of Science and Technology, Hisar, and also on my personal behalf, I would like to put on record my sincere thanks to, first of all, to our Honorable President of the Indian Economic Association, Professor V.K. Malhotra, for giving us an opportunity to organize this panel discussion and constant support and guidance in this regard. We are thankful to you, sir. I am also thankful to Professor Madan, the Secretary of the Economic Association, for constantly keeping in touch, providing all type of logistical support, and also maintaining this technical support. That was, I think, wonderful. And we could, without any disruption, we can complete the discussion. And my special thanks to our chief guest, a very respected and economist, as we know about him. The same thing could be noticed here when he speaks with his vast experience and to the core of his heart. And this is the gems we could, take from him. So he had given a number of ideas, how can we move forward regarding private sector, NBFC, or fiscal policy, monetary policy. A lot of research idea he has given to us, and he had also given his perspective on in Indian economy. We are thankful to you, sir, for giving us a lot of ideas and direction in future to move forward. And more than 200 persons were there at one time connected to this platform, and I suppose around 2,000 more persons are there through Facebook and YouTube. So this All India Economic Association is a very, is spread all over the country, and so your views are reaching far and all nooks and corners of the country, and I'm sure it will have some impact in time to come. Thank you very much, sir. I would also like to put on record my sincere thanks to our Honorable Vice Chancellor, Professor Kishor Kumar, who as a true leader, always supporting and encouraging and coming forward to take the lead and help us in, when I discussed with him, he was very happy and coming and supported to have this panel discussion by Guru Jammu Kashmir University, and all his support. I am thankful to my Vice Chancellor. I am also thankful to our panelist, Dr. Soumya Kanti Ghosh, the Group Chief Economist of State Bank of India, who agreed to be part of this discussion and came out with a lot of new things regarding how Indian economy is doing and behavioral changes taking place in the economy, how these things are going to impact the economy in the time to come. So with these things, we are benefited a lot. These are the new dimensions to the economy, emerging ones, and he has been tracking the changes very closely, so we can understand that we need to take his words and learn a lot from him. So thank you, Dr. Soumyakant Ghosh, for your enlightening us with your views and your insights on the Indian economy. We are also thankful to Dr. D.K. Joshi, the Chief Economist of CRISIL, for enlightening us, for giving his perspective, his view, a more detailed view on Indian economy, that sectoral dichotomies like private, public, and rural, urban, small, and large. And so we can understand slightly more that how, when things are changing, ultimately there may be some may be lagging behind, some may be moving forward. So how things are panning out. So with your insight, we could gain a new understanding of the Indian economy, how it is emerging after this COVID. So we are thankful to you, sir. We are also thankful to Dr. Badrinarayanan. First of all, I would like to, thank him for one thing, that this inconvenient time to him, he is in US, Seattle, and when this conference started, it was 3 a.m. in the morning. So despite this odd time, he accepted our request to be part of this panel discussion. For this, I am very thankful to Dr. Badrinarayanan. He is a person who has been into academics, who is into consultancy, who is into a lot of things. So he also gave his perspective that how India can gain from the global world change. Changing global scenario, how India should take benefit of this. And in the past, we have missed the bus, but this time we must be proactive to take care of all these things. Thank you, Dr. Badrinarayanan. We are also thankful to Professor M.R. Murthy, a very respected economist of the country, who made a very logical point here, that the separation in different policies, trade policy, industry policy, technology policy, investment policy, these separations are creating a lot of unnecessary frictions in the economy, and there should be a coherent, integrated policy for all the sectors. And I can add to this is that education policy should also be part of it, R&D policy should also be part of it. Then only we can reach the, we can achieve our targets in a real sense. So thank you, Professor Murthy, for giving us your perspective. And Professor Mohanty gave us, I'm personally very impressed with the way he explained that how Indian trade is there, how China is impacting us, and where we can take lead, and how can we manage our trade and economic management. When we talk about China, a number of myths are there. How can we take care of these things? So with these things, when we have informed understanding of an issue, we can address the issues in a much more effective manner. So thank you, Professor Mohanty, for giving your perspective and understanding to all of us. I take this opportunity to thank all the office bearers of Indian Economic Association who supported and remain part of it in this panel discussion, all the delegates, all the other members, and my fellow colleagues from my university who are also part of this discussion. So thank you very much.
Thank you very much, sir.
That's all from my side. Dr. Madan.
Thank you to all the resource persons and delegates for joining in this first technical session. And just one announcement that tomorrow we will have a very important session on agricultural reforms, the road ahead, at 11:30 a.m. And that session will also last up to 1 p.m. So in that session, Professor Satish Verma, RBI Chair Professor from GRIT Chandigarh, he will be the moderator for that session. And Professor Dr. B.D. Nayak from the board, Dr. Shivendra Kumar Srivastava from ICAR, Dr. Rajiv Kumar Vasne from ICRIS at Hyderabad, and Dr. J.S. Yadav from Haryana International Horticulture Marketing Corporation, and Professor D.K. Norial from IIT Roorkee and former Vice Chancellor Kumayi University. These will be the experts tomorrow. So all of you are requested to connect on time before 15 to 20 minutes so that the session should start at the right time. So once again, I am very much thankful on behalf of Indian Economic Association to all the resource persons and delegates who are connected with us. I noted this thing that around 3,000 people today joined and connected with this YouTube and Facebook Live in this session. And that is a very good thing for the resource persons also and for the IA also. So once again, thank you very much, and we will meet again tomorrow. Thank you, sir. Thank you.
Thank you.
Thank you, sir. Thank you, Bilal sir.
Thank you. Thank you, everybody.
Thank you, sir.
Thank you.
Thank you, Malhotra Sahab.
Thank you. Thank you.
Thank you, sir.
Thank you, sir.
Thank
Thank
you.
you, sir.
Sir, thank you.
Thank you, Dr. Madan.
Thank you.
Thank you,
Madan
sir.
ji. Thank you. Have a nice time. Let's meet tomorrow
Thank you
morning.
very much, sir.
Yeah,
Thank you, sir.
Thank you, Madan sahab. Madan sir, tomorrow see you.